In this section, we want to look at some of the benefits of using stock options. When amateur investors use options because they're attracted to the leverage that they can use to potentially make a lot of money. Professional investors use options so they can take a position in a stock with limited risk. In other words, amateurs are attracted to making money, while professionals are attracted to managing risk. To be a successful investor, you must understand how to manage risk to consistently make money. So let's look at an example of how a stock can do things that are unexpected and unknowable. This is ServiceNow, which is a cloud provider, and as you can see over the past several years, they've had a very good chart. But earnings came out in January, and this is what happened to the stock after the earnings. Now, what's so strange about this is how good their earnings were and what happened to the stock price. Let's look at the actual news clip that came out at 4:43 p.m., which is after the market close on January 27th. You see that ServiceNow had $32 million net income, which was 19 cents per share, which is well more than twice what was expected of 8 cents by the street. The revenue was up 44%. Yet why did the stock go down like this? The point is that it's not important why the stock went down. The fact of the matter is that the stock did go down and went down without any foreknowledge that it was about to happen. This is some of the vagaries of dealing with the market, so it's important to learn how to manage your risk in doing that. This stock has made nearly a 50% reduction from its high and has gained just a little bit back to the 55 area from its low of 45. So you're still way down. So let's look at this stock if we were making an investment. You can see it's in a strong uptrend as evidenced by the 20-week being above the 40-week. We've seen several periods where we've had a nice move and a consolidation and breakout to a higher level. So there's no reason not to consider that this breakout to this level might take us to new highs. Looking at the performance of the sector that NOW is in, it's in the technology sector. You can see that technology was outperforming the S&P 500 by 1 1/3% at this period of time. So this would be a strong sector to take a look at. So let's take a look at how we'd put a trade on. Looking back at October 22nd, we would consider putting on what is called a call vertical. We're going to buy the February 75, we're going to sell the February 90. So what we've done is for $5.85, we've bought an opportunity to take a $15 profit in this stock if it moves up to $90 a share. So now let's compare where we are if we were at an option versus stock. With the stock, if you'd purchased 100 shares on October 22nd, you'd have paid $77 a share. On January 27th, the stock closed at 75. Earnings came out after the cash market closed with a strong beat, but the stock opened the next morning at 57.82. With the drop after hours, there's no way to escape the heavy move down. At the February expiration on the 19th, the stock was trading at 57.74. So from 77.22, you would be down 22.48 per share with stock. With the options, if you had purchased the February 75.90 call vertical, you would have paid $5.85 per share. On expiration, your position would be worthless and you'd realize a $5.85 per share loss. That's still $16.63 less than the same position if you were in stock. So your loss is reduced by 74%. So by using options, we reduced the initial risk from $77.22 per share to $5.85 per share. Options help protect from events that happened when the market is closed and you can't do anything to protect yourself. The initial options price acts as a stop on your risk. So with the options, you've committed to a maximum risk when you initiated the position, and therefore you've defined your risk up front. And managing risk is an absolute must to successful trading, and it should be your first priority. So I hope this gives you some insight into how you can use options to minimize risk in your trading.